guys, welcome to Ride On Academia. Still in our series on the subsidiary books. Today we are going to be looking at the general journal. Alright. General journal, sometimes called the journal proper. Alright. Now our general journal is a subsidiary books that records every other transaction that may not appear in other subsidiary books. Okay, now in our subsidiary books edition, we have been dropping videos on sales day book, purchases day book, returns inward, returns outward. So our general journal now records every other transaction that cannot be found in these subsidiary books. Like I said, if we buy asset on credit, it cannot be recorded in the purchases day book, right? But that asset that was bought on credit can be recorded in the general journal. So every other transaction that cannot be recorded in other subsidiary books can be recorded in our general journal. All right, our general journal is also used for other activities like the opening of entries. Okay, journal can be used in opening entries for the business and already existing business, so you can open an entry for the business using your general journal. All right, it is also used for the correction of errors. Now on correction of errors, we've dropped videos on a lot of errors and how they can be corrected using the journal. Okay, the format of the journal is quite different from that of the sales day book that we've been using before. So we have this is our format for the journal. We have our dates, we have our particulars, we have our debit as well as our credit. So in this case, we will be listing our particulars, the different accounts to be credited, the account to be debited, and the amount. Okay, and then after we have done that, we'll be writing a short explanation for the transaction. All right, so like I said, our journal can be used for different reasons. We have opening of entries, correction of errors. We can also transfer items between accounts using our journal. We can transfer from account to account using the journal. And then correction of error, like I said, we already have those videos. So in this video, we'll be looking at the 3 uses of journal. Okay, and then we'll be taking examples. The first we'll be looking at is when we use our journal to buy an asset or sell either of them. You can use it to buy and sell or sell a fixed asset, a non-current asset, okay, on credit. So when an asset, a fixed asset, is bought by the business or it is sold by the business on credit, the entry goes to the general journal. Okay, so our example will be taken. Okay, we have that on September 4th, okay, this account belongs to Jonas Enterprise. Okay, still Jonas Enterprise. This account belongs to Jonas Enterprise. We have that on the 4th, we bought equipment. Equipment is a non-current asset, that is a fixed asset, okay, from AYZ Ventures on credit. So the first thing we'll do, I'll be raising this. The first thing we'll do is to bring in the owner of this account or this book of entry. In this case, with Jonas Venture. Okay, this is our general journal. Good. So we have that on the 4th, right? On the 4th of September, we bought office equipment from AYZ Ventures on credit for 400,000 naira. So we have to, in fact, the format of the journal is very different. So when we enter our dates on the 12th of September, okay, the format of this is, okay, 4th is different from other subsidiary books we'll be looking at. So we've entered in our date. When we come to our particulars, we'll be looking at the 2 accounts involved here. So we must be able to know the 2 accounts, which is to be debited, which is to be credited, before making our explanation. Okay, so if we bought office equipment from AYZ, that means AYZ is giving out equipment. Do you understand? So their value is going out, their asset value is going out. So we'll be crediting AYZ account, and then the people receiving is Jonah's venture. Okay, the business is receiving, they are the one buying on credit from AYZ. So since they are receiving, they are the receiving account, we'll be debiting their account. Do you understand it? So in preparing our general journal is quite different from other subsidiary books. So here, since we are buying assets on credit, both office equipment, what we'll be having here is the office equipment account of the business of Jonas Ventures business. Okay, we'll be debiting office equipment because we are having an increase in office equipment. Okay, equipment is an asset. Do we get it? The office equipment is an asset. So when asset increase in asset is debited, whereby the company selling to them on credit, that is the AYZ Ventures. AYZ Ventures is selling to Jonas Ventures on credit, but their asset is reducing, right? And then a decrease in asset will be credited. So because they are selling on credit, we will be crediting their account. So AYZ Ventures will be crediting their account with the amount of 400,000 naira. So when we have entered the account to be debited comes first, account to be credited, we will now make a simple explanation of what happened. So in this case, we'll be saying for assets that was bought on credit. Okay, alright. So when we are through with this, we just rule a line across. Alright, so I've been able to show you how we can use a general journal in recording for asset that was bought on credit. The next example I'm going to be taking is how we can still use this same general journal to make transfers from one account to another. Okay, we'll be taking an example very quickly. Good. So we have that a customer, Godwin, who was owing Jonas Venture Enterprises. Okay, a customer, Godwin, that's a debtor, who was owing Jonah Venture Enterprises the sum of 35,000 naira, was declared bankrupt. Okay, so that is the business of this customer went bankrupt. There was no money, maybe the business closed down. Okay, but although he was owing this very business, Jonas Ventures, 35,000 naira. Now his friend James, who was also a customer, all right, with Jonas Venture, decided to settle the debt on his behalf. That is, James is coming in to bear the debt of his friend Godwin, all right, on his behalf by writing a letter to the company to transfer the debt to his account. So that transaction will be dealt with in our general journal. So we have the date is on the 10th of September 2016. We are going to be making a transfer. The first thing we are going to be looking at in this case is the account to be debited and the account to be credited. All right, now since they are both customers to the business, we are making a transfer from Godwin's account to James' account. So our general journal will only be showing the transfer made from Godwin to James. That means Godwin's debt will be reduced, and then it will be transferred to the account of James in this case. Okay, so they are both debtors, right? So it means James' debt is increasing, whereas Godwin's debt will be reducing. So we'll be debiting James' account because he is also a debtor. There will be an increase in debt, okay, of the amount involved here is 35,000 naira. All right, and then Godwin, who went bankrupt, okay, and his friend is saving him, will be crediting his account with 35,000 naira. In this case, he's no longer owing us, okay, because his friend is now taking over that debt. So we are through with the transfer between these two accounts, the two customers' account. So we can now explain a very short explanation that being transferred This is our transfer of debt from Godwin to James. Okay, we are transferring from Godwin to James account. Now the last example we're going to be looking at in this video is how we can use our journal in opening entries. All right, our format still remains the same. In this case, you can see that there is no folio, right? Our format still remains the same. We want to see how we can use our journal in opening of entries. So we still have our date, debit and credit. Okay, so we're going to be using our journal for to open our entries, okay, for an already existing business. Quickly, we have that on the 1st of March, this is for a separate account anyway. On the 1st of March, Mrs. Juliana, who is a dealer in women material, had the following assets and liability at the beginning of the year. So Mrs. Juliana owns this account, right? So we'll be entering her name, Mrs. Juliana. Okay, very good. And this is her own general journal. So Mrs. Juliana had the following asset and liability at the beginning of the year. We have office equipment 2,400, office machinery 600,000 naira. We have receivables. Receivables is another word for your trade debtors, the money that is due to be received. Okay, we have receivables 8,000 naira, cash 10,000 naira, and then payables, that's your creditors, people that you ought to pay, 20,000 naira. So we are asked to open entry. So in this case, what we're trying to do is to determine our capital. Simply, we know the capital for a business is the excess of assets over the liabilities, total asset over total liability. Then we have our capital. So when opening our business on the 1st of March, all right, so we have gotten our date on the 1st of March. Now, so we'll be entering for all the assets on the debit side, then all the assets on the credit side, and then the difference will be our capital. And then we have opened the account for the year. All right, now, so we have for assets on our debit side, we'll be having office equipment is a non-current asset. So we'll be having office equipment 2,400 naira. All right, so to be having office equipment. Another asset we have is office machinery, also a non-current asset. So we'll be using our machinery, which is 600,000 naira. Now the next one we are having is our receivables. Our receivables, and that word for the debtors. Okay, so our receivables is 8,000 naira. This is a current asset, right? And then we have our cash. Our cash is 10,000 naira. So cash in the business at the beginning of the year, another business year, was 10,000 naira. Now then we have that payables, and that was for creditors. So our payables is 20,000 naira. So that will be a credit transaction, right? Because creditors are entered in on the debit side. So either you use creditors or let's use payables. Payables of 20,000 naira. Now we're going to be balancing our account, total assets minus total liability, to be giving us our capital. Remember, total assets minus liability to be giving us capital, right? So when we total this, we're going to be having 620,000 naira. When we total this, so we are going to be lessing our liability, which is 20,000 naira. That is, our capital will be 600,000 naira. All right, so with this we can say that our business capital, which is our balance, is 600,000 naira. So we'll be having a balanced account. All right, as for with our asset and liabilities, our capital and liabilities will be having our assets. So with this we can say that this is the what? Asset Alright, so this is our asset, liability and capital at the beginning of the business year. Just a little explanation. Okay, so this is how a journal can be. There are other uses of journal, but for the sake of this video we will be stopping at just these 3 uses. Alright, so with this we have come to the end of today's lesson on the general journal. If you've not liked our videos, if you've not subscribed to our channels, if you've not been sharing our videos, please do so. We'll see you in our next class. Thank you.